Okay. All right. Thank you, everyone. As I just mentioned, my name is Justin Carbonneau. I'm one of the partners here at Validea and Validea Capital. Today's webinar is going to be giving you an overview of our investment research site and the tools that are on Validea that I think can help in your own investment process, whether it be analyzing stocks using the models we run, some of the factors we look at, looking at the model portfolios that we run here, both stock and ETF model portfolios, and then some of the other tools that I think can help today's investor, whether you're a do-it-yourself individual investor or professional investor. I think on today's webinar, we have some existing Validea users. We have some folks that are new to Validea and are probably learning about us for the first time. And then I think we also have some actual clients of our separate asset management firm, Validea Capital, who are just always interested in sort of learning about the strategies we run and how they're invested. And so that's what, just to a large extent, we'll be looking at some of those strategies today. I should mention Validea, a lot of what you're going to see here today is behind a paywall. So this is a subscription-based business. There's years and years of work and development that have gone into building Validea, and that's what you'll see today. There's obviously expenses on the data feed side that we have to pay for data. So this is a subscription-based business model. Our subscriptions run anywhere from $270 a year to $900 a year, depending on whether you're standard or the pro. But for attendees on today's webinar, what I'm going to do is actually at the end, I'll put a link that will give you access to the site for a 25% discount. So the fact that you're sitting here with me today and learning about Validea, we want to reciprocate to those people that want to give Validea a try, and I can save you a little bit of money by clicking on that discount link at the end. So the first thing that I want to show you is something we call our Guru Analysis tool. And the way that you get there is you go research Guru Analysis. I was looking at Coke earlier, but let's just look at Apple. So what you're seeing here is all the different Guru-based strategies we run on Validea. So let's just talk about this for a minute. What we do here is we take, based on books, research, and academic papers, we look for fundamental strategies, for the most part, that have long-term track records of success, either real-world performance, or in many cases, some of these are based on back-tested models or academic papers. But we look for strategies that have those characteristics and that can be quantified. And then we basically build models off of those sources. So on Validea, there are 22 different Guru-based strategies ranging from methods that are probably very popular. This first one on the list, Warren Buffett. I mean, most investors on this webinar probably know who Warren Buffett is. We base our Buffett model on the book Buffettology, but it's all different individuals. So Benjamin Graham, Peter Lynch, Jim O'Shaughnessy, Martin Zweig. There's academic individuals and research in here, Partha Mohanram, who's a professor at the University of Toronto, David Dremin, John Neff. So it's a whole series of investment strategies that have been extracted from public sources. And what we have done is built a computerized system where you can type in any ticker symbol, any stock that trades in the US, and see how each strategy would score the stock and what criteria, what variables it passes, and what variables maybe it doesn't pass. So I like to use Apple as an example. What's neat about Apple is, as many of you probably know, Apple is the largest position in Warren Buffett's portfolio. And our Buffett model actually was scoring Apple very highly, well before Buffett was actually buying it himself. It doesn't always work out that our model's ahead of what Buffett is actually buying, but in this case it was. So what do we get when we click into each one of these names or Guru models? What you're seeing here is at the top of the page, just a quick synopsis or a company snapshot of what the company does. But as you come down into the page, you're actually seeing the detailed investment criteria as to why Apple passes or fails this particular methodology. In this case, Apple passes all the different criteria. So this model starts, I'm not going to go through each one of the criteria. That's not the purpose of this, but just to give you some idea of what these models look at. It starts by looking at earnings predictability. So have earnings increased over the last decade, the level of debt a company has, its return on equity and return on capital. It wants to see higher than average ROE and ROC. So it knows that it has some moat around the business. And then a whole bunch of other investment factors that we extracted from Buffettology. But the point is for any stock in your portfolio or any stock that you're interested in buying or maybe even selling, you can get the scores on those stocks using this system we've created. So if a new name, if you're investigating a new investment opportunity and you're kind of not sure fundamentally, how it looks, maybe you have some criteria you look at, maybe you look at the PE ratio, maybe you look at the dividend yield, maybe you look at the chart. But by using all of the guru models in guru analysis, you can start to see whether or not the stock has other favorable characteristics through the lens of all these different strategies. So there's value strategies in here, which that would be kind of like the Benjamin Graham type investment strategy. You have value and quality. I'd say that's like Buffett and the Greenblatt models. You then have growth at a reasonable price. That's more the Peter Lynch type of investing approach. And then we have some pure growth strategies. Martin Zweig, Mohan Ram strategy is a growth strategy. And then we go all the way over to pure momentum. We run a strategy based on the book Quantitative Momentum that was outlined by Wes Gray of Alpha Architect. So what this guru analysis tool does for you, it can help you validate your investment ideas or maybe key you in on some areas of concern you might have. For example, if you put in a stock's ticker symbol and the company doesn't make money and it's trading at a crazy valuation, I'm not saying that's necessarily going to be a bad investment because sometimes those types of stocks do well. It's just that type of security wouldn't score highly according to any of our models really. And so what you would see is all, low scores. And that might give you pause and say, wait a minute, I want to be in companies that are a little bit stronger fundamentally. So that's how people use this guru analysis tool. This is really the foundational way that we score and rank stocks. And I'm going to show you how we actually put that into action in a moment. But the other thing I want to show you on the stock specific side is under the factor report. What we've done here is we've taken the major investing factors. So the value factor, quality factor, there's negative quality, momentum factor, low volatility. And what we're doing is we're ranking stocks based on those sub factors in those factors. So this is another quick way where you might, by entering a stock's ticker symbol, you're going to be able to see how well it scores on a percentile basis based on value. Higher is better. So, Apple isn't super cheap right now. It's, in the 34th, it's in so there's 66% of stocks in the market are cheaper than Apple. But from a quality perspective, and this is what you would anticipate, from a quality perspective, Apple scores very high, as we just saw by looking at Apple through the Buffett methodology, which is like a value, but more even quality type of strategy. Apple gets very high marks. And so I'm just showing you another way that you might use what we've created here to help either validate an investment idea or get a quick sense of how a stock stacks up fundamentally using the major investing factors. Before I move on, I want to say one other thing. The chat is open. So at the end, I will try to answer questions if there are any questions. But what I'll do is I'll get to those at the end of the chat, if you don't mind, so I can get through this presentation and people can kind of go on if they want to hop off. The next popular feature that I want to show you is our model portfolio section. And what we've done here is taking all of the guru strategies that we follow and some blended models. We track 10 and 20 stock model portfolios that are rebalanced over certain time periods. And we track and we output what is in the portfolio, what to change. So we tell our subscribers and users for each strategy that we run, the stocks they should own and when to make changes and what changes they should make. So this is for someone that says, you know what, let's use the let's use the third one down as an example. Let's use the Jim O'Shaughnessy Value Composite Investor Model, which is based on Jim's work, his book, What Works on Wall Street. He had back tested and found that a model that uses a composite of value factors actually had very, very good long-term performance. And we run multiple strategies based on the models in What Works on Wall Street, but the value composite is one of them. But let's say an investor says, you know what, I really believe in this value composite methodology. They look at the performance of this model. It's something they want to start investing in. So we run the model both on a 10 and 20 stock basis. What you're seeing here on this page, the default view that you're always seeing with our portfolios when you come in for the first time, is the optimal portfolio size and rebalancing period for the specific, for all the unique strategies. So in this case, the 10 stock tax efficient model, which I'll explain what that means in a minute, is the optimal way, has produced the best long-term performance for this particular strategy. What I mean by tax efficient, let's just talk about rebalancing for a second. So you can follow, we rebalance the portfolios on a monthly basis. So those are rebalanced once every 28 days. You can follow quarterly rebalance portfolio. We rebalance the portfolios annually, which usually happens around midsummer. And then there's this tax efficient method, which what we mean by tax efficient is we're running the model so that it's focused on harvesting losing positions that don't score high according to the methodology anymore, or holding our winning positions for 12 months or longer. When you do that and when you get fully synced up to the tax efficiency of the model, what happens is you're generating very little short-term gains. And so for taxable money that is being invested using our strategies, the tax efficient and even the annual rebalance portfolios, they're just much more tax efficient than doing it quarterly or monthly. What I will say though is that what tends to happen, especially with the momentum and growth type strategies, is a more frequent rebalancing actually tends to do a little better. So in some cases, you might get excess return with a monthly rebalance, and that might help overcome some of that tax drag if you're following it with taxable money. If you're obviously investing in an RIA, then it doesn't matter. But so that's a little bit more, color on the rebalancing and what we mean by tax efficient. I don't know, I could be wrong about this, but I don't know of any model provider out there that has sort of a quantitative, systematic, model-based offering, but that also has this tax efficient component to it. So that is a little bit unique and I think pretty cool to us. But let's look at this value composite model. I just clicked on the name. So what's happening here is you're coming and you're seeing the portfolio. This is a pretty nice chart. I mean, what you're seeing is, basically outperformance through the model's history. You're seeing a pretty big drawdown here, and this was the early 2020, but then you've seen a massive reversion higher as, a lot of these deep value stocks have produced, amazing returns, especially in 2020 and 2021. On this page, you can see the sort of top level history as well as the return history here. So you're seeing the annual year by year history for this strategy. One of the things that I want to point out is all of our models will have periods of, relative underperformance. Any portfolio I would show you would be, you'd have periods when the model was trailing. So that's just a part and parcel of these highly focused, concentrated strategies that look nothing like the market. You can get these periods of underperformance. So it's very important for investors that are considering this, using this to, maintain, first of all, find a strategy that they really believe in, but then maintain a long-term perspective and conviction in following the strategy. Because ultimately, the strategies will struggle at times, and you want to be able to stick with them. You don't want to invest in a strategy and then have it have, a down year and you just completely abandon it because it underperformed for like the last 6 months. I mean, that's not, investors that do that, these strategies absolutely aren't for you. If that's you, you should be just buying the market and calling it a day. But these strategies are very different and highly active with tons of active share because they're only holding, 10 or 20 securities at the max. As we come down to the portfolio table, here are the current holdings in the portfolio. You can see when the stocks were added. So here are the 10 stocks that scored highest at the time of the rebalancings were being done. There's some winners and there's also some losers in there, which is what you would expect. Some of these holdings have been in there for a while. So, you're seeing some green, but you're also seeing some red. What you're seeing as you come down the page is you're seeing the last portfolio rebalancing, the changes that were made, and also you're seeing the date of the next rebalancing. So what we're telling you is on June 24th, there's going to be potentially some changes. And last month, we actually added Jackson Financial and Beazer Homes, and we removed Cons and Posco Holdings. This page also displays the current top-rated stocks. And what you're seeing here is if you were to follow this portfolio today, what stocks would you invest in? And here are the current top-rated stocks. We put this on this page in all weeks except the week of the rebalancing, so that if an investor wants to sort of get in the portfolio and get in the top names as of today, they can, and then ultimately you would have to get synced up to the portfolio with the rebalancing changes. So with the tax efficient model, it actually takes a little time for that syncing up to happen. But if you're following a monthly rebalance portfolio, you would obviously just get synced up right on the next month. With all of our models and strategies, they come with a explainer video. These are on our YouTube channel under the Validea channel, not the Excess Returns channel, if anyone is a follower of our podcast, Excess Returns. But we've tried to do a lot with content here in terms of educating people around the strategies, what goes into them. When you're on any of these model portfolio pages, if you click on any of the tickers, that's going to bring you back over to Guru Analysis, and it's going to show you the reasons why the stock scores the way it does through the specific methodology that you're looking at. Let's just go back to the portfolio page. And you'll see in the dropdown, the portfolios are broken out to the first part of the list and the second part of the list. So these are all in our standard package. And the names below are in the pro package. So when we first launched Validea, we started with these, initial sort of strategies. And over the years, we've added other strategies and we've segmented those out into different subscription plans. But just a couple other things on this page. There's a performance dropdown, so you can see how these portfolios have performed over various periods of time. And then scrolling down the page, we do have some consensus portfolios here, which are different blends of strategies. So one of the things that we do for capital management clients is we're blending all these different models together. And we're generally holding baskets of at least 30 securities for our capital management clients. But this idea of blending strategies is something we sort of strongly believe in, because it helps remove some of the risk of a strategy underperforming. I mean, if we're just invested in the value composite model or just invested in the Peter Lynch growth at a reasonable price strategy, there's a lot of strategy specific risk there. And if that style sort of falls out of favor, there's a likelihood that that portfolio will also be impacted. So what we sort of are believers in is blending the portfolios together, whether it's a value portfolio we're talking about or sort of something that's more of a mix of value and growth. It's this blended approach that can help remove some of that strategy specific risk. So this is a pretty popular tool on Validea. A lot of people use it, and it really comes down to finding the strategy that you believe in, finding the one that you can stick with, finding the one that works for you as an investor and your temperament. I mean, if you're someone that, kind of can't stand making changes to the portfolio too often, something like a monthly rebalance portfolio probably isn't for you. If you believe in strong price momentum and, that's something that you sort of have already in your investment process, then something like one of our more maybe momentum or growth type strategies that are rebalanced more frequently might be a better fit. So it's kind of finding your personality as an investor and then trying to find the strategy that best fits that. So that's one way that we take the Guru models and we make them actionable. Let me also show you another popular tool that is pretty powerful when we get into it. And this is our Guru stock screener. And what we have created here is a way that you can screen for securities that either pass one strategy, pass multiple strategies simultaneously. You can mix and match guru strategies. You can add in your own fundamental filters. You can further refine your screen by sector or industry. So there's a lot to play around with here in an effort to find, good investment ideas. I think what the market is, we don't know where it's going in the short run, but what we do know is there's a lot of stocks that are down, some down quite significantly. So, using screens to source and find new investment opportunities can be good. And especially during times like this, you can probably find some great opportunities if you have some dry powder or you're looking to allocate some capital or maybe rejigger things in your own portfolio. So let's kind of go through a few examples. Let's say I'm a fan of Peter Lynch. So Peter Lynch, One Up on Wall Street, growth at a reasonable price type of strategy and investor. And I want to look for stocks that pass the Lynch model I selected strong and some interest, and that's going to give us, actually, let's put that at some interest, or strong interest, excuse me. That'll get the list to a more manageable. Sorry about that. So I'm just going to click out of that for a second. And we're going to go Peter Lynch, and we're going to go strong interest. So that means at least 90% or better. You're seeing a real long list of stocks, too long for us to manage. And so let's try to narrow that down. Then let's say, I'm also a fan of maybe Joel Greenblatt. Some of you might know the Joel Greenblatt magic formula strategy, which is a kind of combining value and quality. Let's add that to the mix. Okay. So now we get a much more manageable list. There's probably about maybe 30 names on here. All right. Maybe that's culled down enough for you, but maybe not. Now let's say, I want to find stocks that I know have some momentum behind them because I really don't want to catch a falling knife. I want to see that, these stocks have maybe turned a little bit. Maybe they're exhibiting strong price strength. We run, as I mentioned, a strategy based on the book Quantitative Momentum written by Wes Gray. We'll select strong or some interest. We'll see if there's any momentum names. Okay, so here we go. So, I really have gotten it down. I've gotten it down to 3 names from that list of, maybe like 100 or 200 securities that score high according to these 3 predefined models. So, and Regeneron's in here and Reliance Steel, those are 2 names you might be familiar with. So that's a great way. These models are built for you. They're already done. You don't have to come up with your own criteria. I think it's important to understand what criteria is in the model, but these are, already developed screens based on fundamental strategies, and you can combine different strategies together to find different investment opportunities like we just did. So let's look at another way we can use a screener. I'm going to show you 2 more ways. I'm just clicking out of here. Okay. So now let's say we want to find stocks that pass multiple strategies. We really don't care necessarily too much about what strategy. We just want to find stocks that we know score highly according to a number of strategies, because that gives us the confidence that they score high fundamentally, through some of these models, some of these methods. So I'm going to select stocks that have strong interest from 5 or more strategies. Let's see what that gets us. Okay, nice. So we have a pretty nice list here of stocks. It's not too long. We could sort of tackle this. Some of the names you're probably going to be familiar with. But then let's just say, I kind of value dividends. So I want at least maybe a 3% yield on the stocks. So there you go. We came up with, 6 names that get high scores according to a number of our strategies that score that pay at least 3%. And by the way, many of these stocks have actually performed quite well. I'm looking at the relative strength. It's all 80% plus, which probably means one of these a lot of those 5 stocks that score 5 or more, there is relative strength used in a number of our models. So it's probably I bet if we looked at the actual models that we're selecting, we'd probably see that one of the relative strength indicators is being utilized in one of the models that is being picked up by. Okay, now let me show you just one more way that you might want to, that I think and these are really just, high level examples. There's a lot of ways that you can use this screener. And I think it probably will really show through in this example. So we know technology has been beaten up. So right here, I just said, let's start isolating by sector. I selected technology in the dropdown right here. Okay. Now let's say I want to see names that are at least 25% below their 52-week high. So I want to see the names that have been beaten up the most. So you're seeing a pretty long list of technology names here. Still probably too low for too many for us to deal with. Now let's say, but you can start adding in all these different criteria. So we have market cap. So let's say I really only want pretty much companies that are, large cap names, because I don't really know the small cap tech. I don't really want to play there. So, I put 25 billion for market cap. So now the names start becoming much more manageable. Now let's say I want dividend yield of at least 3%. So there's some tech stocks out there that pay a nice dividend. Okay. So here we go. And that really brought it down. Intel, Cisco, Texas Instruments, Broadcom, and ABB Limited. And all of these score highly according to the Guru strategy. So Intel scores highly according to at least 7 of our models, Cisco 6 of our models, Texas Instruments 3. And then what you're seeing in this table is, a number of different metrics related to the company that we display. So those are just a few, examples, ways that that investors can utilize the screener. And I encourage you, if you're an existing subscriber, you can play around with that. If you're not an existing subscriber, there is some limited functionality there. But hopefully that's helpful in terms of seeing how, we use it here and how also investors utilize it. A couple more things. My goal was to have this done in about 40 minutes. So I've got about 12 more minutes left. And with that time, let me show you a few other things. I'm not going to spend as much time on these next features just because what I've shown you, Guru Analysis, the Guru Portfolios, and the Guru Stock Screener, those are the more popular features on the site. But over the years, we've sort of developed other tools and things that I think, for some investors might be interesting. So we have a series of ETF model portfolios we run. So instead of holding individual ETFs, instead of holding individual stocks with these models, we're buying ETFs. We have factor rotation strategies, which that are looking at factor ETFs and then trying to rank and sort them by if there's value there, if there's momentum there. We run a composite, and we run one with some macro indicators. So these are factor ETFs that are being held in these portfolios, and then we run them long only. We select them using factors, and we run them long only and with trend. So what that means is we run them with trend following. So sometimes they're in, sometimes they're out of the market. We also have sector-based portfolios. Again, it's selecting the sector-based ETFs that are exhibiting the most value, exhibiting the most momentum, are the most attractive based on a set of macro indicators that we look at. And then we have a composite sector rotation strategy, and we run them with and without trend. And then we run a series of risk managed portfolios here. And these are strategies that combine, they each do a number of different things, but effectively what it's doing is combining asset class diversification, momentum, correlation, and trend following. And depending on the complexity of the strategy, some of these are very simple, like the permanent portfolio, as many of you probably are familiar. That's just 25% in stocks, long-term bonds, short-term bonds, and gold. And then there's things like protected asset allocation, which is looking at across 15 different asset classes, ranking them by momentum, being in the top performing ones, and then having the ability to raise cash or go to a crash protection stance if the momentum starts to deteriorate around the majority of the assets. But but I encourage you, if you're sort of looking for an alternative, something a little bit less risky, those strategies could be interesting to look at. We manage plenty of our clients that are in retirement that need some type of reduced risk stuff. Some of these strategies form the basis of how we're managing that money. That's a little bit, should be invested with less risk. These strategies generally will have, especially the factor in the sector, they're going to have higher risk than the overall market, but they're not going to have as high risk as the stock portfolios I showed you before underneath the model portfolio section. Those, because they're individual stocks, they're going to have a lot more variability in their returns. Underneath research, I wanted to show you a couple other things. So this idea of trend following. So we run a part of the Validea site that applies a trend following methodology, which is a technical system that moves in and out of asset classes based on moving averages. We apply trend following across, I think it's like 45 major asset classes in our guru-based model. So what you're seeing here is for the US market and international, a lot of these things, our trend following system has kicked on a sell signal here because there's a downtrend. We're in a bear market now, technically. So what this is trying to do is it's trying to protect capital from the worst of a bear market. But what it will also do is once an uptrend gets reestablished, it will come back in. What I would say with trend following in general, it can be very difficult to follow in some instances because trend following can get whipsawed. So meaning you could, there's a chance we could be out of the market now and the market's bottomed and we're going to move higher. And in that case, we're going to be leaving returns on the table as once the buy signal comes back in, because we'll have to chase the market higher. But where it's valuable is if this bear market gets a lot worse, then this trend following signal will have reduced risk to a large extent, and so that's a positive. But what I would say is, a lot of times trend following, this signal is wrong, so it ends up being, but when it gets it right, when we actually have that full-fledged bear market and stocks are down, 35 to 40, maybe 50%. That's where you tend to get a lot of the benefit of trend following. And the other thing I would say is it's systematic. As you've all seen on this, webinar, this is not any of us here at Validea selecting stocks or indicating when to get in or out of the market. And we believe in following systematic models, both on the stock selection side, ETF selection side, and also when it comes to trend following, because we want to do everything we can do to remove our own emotion and subjectivity from the investment process. So everything on Validea is obviously systematic. But one of the things that we often highlight here, and this is kind of interesting, is trend following right now in commodities has a buy signal. But where it gets very interesting, specifically with commodities and trend, is commodities have been like a horrible investment for the last going back to 2006. So if you were to have just bought and hold this major commodity ETF that we're applying trend following to, your buy and hold return going all the way back to February of 2006 would have been 1.7% per year. So you're basically you've kept up with inflation, I guess, if you, well, not now, but, if you would have bought that ETF and just held it. But when we apply trend following to the ETF, we actually get, almost 3 times the return that you would have gotten with buy and hold. So when applied with trend following, when held with trend following, you get a 6.1% annualized return. At least that's what it's done historically. And the big important thing here is if you look way over on the right-hand side, there's the max loss. So with trend, you have a max loss of 47%. That's still quite a bit, but it's way better than the 77% max loss you would have realized if you would have just had buy and hold. So for some types of asset classes, trend following can work very good. And commodities, if you think about it, they tend to have these boom and bust cycles. And so something like commodities, trend following can be very valuable for certain things. Up in the research page, so I highlighted trend following. We have a market valuation tool. And I'm not going to go into this in detail, but basically allows you to look at the market's valuation and all different segments of the market relative to its historical valuation based on a number of different valuation measures, and you can compare it. So if you wanted to sort of see how expensive was large cap growth relative to small cap value, you'd have the ability to do that. Or if you want to see if there's any, value in any of the sectors based on how we value these stocks using our valuation metrics, like the factor report that I showed you, we have the ability to do that. So that can be useful. It's kind of gives you an indication of where there might be value in the market today. Then we have our guru ratings changes. This is just on a daily basis, what stocks are moving among the scores. So again, this is an investment idea sort of generation tool. Some people come in here and check daily, and if something catches their mind or their eye, they might, investigate it a little bit more deeply. Or if a name in their portfolio that they have pops up, that would be something that they probably will want to look into. And then we have a strategy ETF matching tool, which kind of takes the guru models and then looks at the characteristics of the stocks that the models are scoring highly and tries to match it to various ETFs. And then a portfolio correlation tool, which looks at the correlation of our models to each other. So if we just take one example here, the acquires multiple model, it's showing you what strategies the model's least correlated with and what ones it's most correlated with. And that could be valuable to someone, because if someone is trying to use these models and wants to use multiple models, looking for ones that are less correlated, think of the idea of combining value and momentum. A lot of people support that idea because those are two very different types of strategies. Maybe when value is doing well, momentum might not be, and when momentum is doing well, value may not be. And so you get that factor diversification. Well, by looking at the correlation of the models to each other, if somebody wants to follow multiple models, maybe they combine two uncorrelated strategies or less correlated strategies to each other. So that's kind of an interesting thing on Validea. The last thing I want to highlight here, and then I'll wrap it up and I'll see if there's any questions, is we do have this alerting system. So you can set up all these different types of alerts. You can add your stocks to here. So if something changes with one of the gurus on the stocks that you're interested in, you'll get an alert. You can add ETFs in here, and you'll get an alert when the factors change. You have strategies. So for example, if you're, a fan of any of these strategies and you just want to see what stocks are moving each day, you can set that up in there. Obviously the portfolios, when you start following a portfolio, we're going to tell you and email you every time the portfolio is rebalanced. We always rebalance on a Friday, and we push out an email notification letting people know that the portfolios have been rebalanced. But this is another way that you can sort of track the portfolios, and we'll send you your email will be tailored to the portfolios that you're following, customized. And there's other alerting features in here too, but I encourage you to play around with that and add in some stocks and ETFs if that's something that you're interested in. We have a blog. I'm guessing some of you on the webinar today came to us maybe from our blog, and my partner and I also co-host the Excess Return Investing podcast. You can subscribe to that on YouTube or Apple Podcasts. That is just where Jack and I will have guests on, or we'll talk amongst ourselves around various investing topics and things that we're sort of seeing in the market. We do a lot of content here. We believe in education and talking to other smart and successful investors and sharing that with our audience. And so that's really the goal of the podcast. And it's been pretty rewarding so far with the feedback we've gotten, but also many of the great guests that we've had on. We've been really lucky. So with that, I'm going to see if there are any questions. But what I'm going to do now in the chat, I'm going to put, here is the discount link. It's validea.com/25% off. And I'm going to put that right in this chat. And by the way, you're going to be getting, over the next few days, there will be some emails that will go out to you. There will be a replay of this. And then there's a few other things that we'll be sending you. So if you aren't a subscriber and you're interested in learning more, that's something that we'll be doing those emails. If you are a subscriber, we'll kind of go through the list and take you guys off so you're not getting hit with anything. But anyways, so let's see what we got. We don't analyze closed-end funds. There's a question in here. You don't consider market sentiment. I believe in some of the ETF macro strategies we do, but I would need to confirm that. What markets do you cover? So we cover, what you're seeing here is U.S. stock or stocks that trade on U.S. exchanges. So that's including ADRs. And then we do have a separate Validea Canada site. If you go in the top nav under worldwide research sites, you should see a link to the Canadian site. That's a separate package, but that's some of our models apply to the Canadian market. Great, thanks for the presentation. So these are some good ones from someone I know quite well. Let me see. Okay, so let's try this. This person's asking the time. He's making a statement that it's the time to buy stocks is when everyone else is selling. You want to buy sort of the cheapest stocks, the stocks that are down the most. And hold those for a year and, wait for basically mean reversion, wait for the rebound. What I would say there is you would use something like something like the Guru Stock Screener. And what you would want to do is you'd want to find the stocks with the lowest relative strength, which are going to be the ones that are down the most. And then from there, I think you'd want to probably try to get some quality metrics in there, because what you don't want to be doing, some of those stocks deserve to be down. Some of those stocks are just not good companies. They're not profitable. They're not making money. Think about the environment we're in where, it's going to be more expensive to borrow money. There's going to be some problems for some companies, but you want to try to find companies that have good quality metrics, low debt, maybe something as you look at the story and understand the story of the stock, once you investigate it further, maybe there's something temporarily that's impacting it that makes it a good opportunity. So that's what I would do. I would use the Guru Stock Screener to start, and then, look for the cheapest stuff based on, you could use value metrics. You could use something like the price to book or PE or, and then couple that with relative strength as well to try to find the stocks that are, cheap based on those metrics, but also have very low relative strength, and then try to layer in the quality component. Let me see. Okay. So I think that's good. If I didn't answer your question, and okay, there are a couple others I see here. Okay, thank you very much. Some good feedback. There's a number of questions here. Okay, on the strategy, okay, so the one question is, does the strategy inception date mark the actual date for the stock portfolios that the portfolios went live? And in some instances, yes. In some instances, no. And you can find that at the bottom of the page. We disclose what strategies are completely a live model, meaning they were launched on the Validea website and tracked from day one, and what strategies are a combination of model returns and back-tested returns. We do not offer exporting to Excel. I'm sorry about that. That's something we'll work on. The trend following methodology is explained. If you go to the trend following page and there's a user guide, you should see it. And I believe I think there's an explainer video. And I believe on our podcast, Jack and I have talked about trend following at least a number of times. And we also had Jack Vogel from Alpha Architect on to talk about trend following as well. So you can look at that one. Yeah, and there's a question of, can somebody request one-off? We have all the data on everything. So if somebody has an individual request and they need like more like correlation data or something like that, like we would be able to do that because obviously we have all the data. So, we do custom work like that for investors. So with that, okay, we're 46 minutes in. I appreciate everyone jumping on with me. Thank you so much. Thanks for spending the time with me on this Friday afternoon or morning or wherever you are. And we hope to see you on Validea. And thanks so much. All right, take care.